Debt to gold. What the ratio might mean for the long-term prices of gold and silver. Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Drew. He's been not on here for a little while because he's been so busy in the Melbourne office. It's just been quite chaotic. It's great to get you back. I know people want your updated opinion on what's going on in these metals. How are you going today, Drew?
Good, Chris. How are you?
Yeah, good. Look, as I said, people want to know, what are you thinking? What's going on at the moment? We've had the price move up. We had a bit of a pullback. It looks like the price is moving back up again. There's a lot going on. You've got a specific ratio you want to talk to us about today, but just talk us through what's going through your mind at the moment.
Yeah, absolutely. I mean, both gold and silver have had a strong run. We were talking about this a couple of months ago that just based on global liquidity and where we were in the macro cycle, there should be a strong move coming up for precious metals. That's now played out, and we're seeing a little bit of consolidation and cool off in the short term for both. I just thought this was a good opportunity to take a step back and look at the bigger picture and just sort of put into context that, while everyone's quite excited about the move that's just happened, really both of these are long-term investments. So if you're looking at it from a, sort of multi-year or even a decade-long view, we really haven't seen anything yet for either metal. And I think this consolidation, as long as it takes, is just another opportunity to take stock of the portfolio, see where you are, see if you've got your allocations where you want it to be, and zoom out and look at the bigger picture. So I really think we haven't seen anything yet for both gold and silver. And as you mentioned, I think we could look at the US government debt as an indicator for where gold might end up in that long term, because it really seems more and more that the price of gold, while it's driven quite strongly by central banks as well, at the moment just seems to be acting quite well as a barometer for US government debt. So the more the debt increases, the higher the price of gold goes. And that's really just because of the simple fact that with the debt, for them to service the debt, they do it by issuing more debt. And what that does is it devalues the dollar, and gold is priced in dollars. So as the debt goes up, the value of the relative value, I should say, of the US dollar goes down. And therefore, the real value of gold in real terms continues going up. And, if we look at where we are with the US government debt today and where we think we're going to be in 10 to 15 years, I think the numbers seem very sensible, but they might be a little bit big for some people to wrap their heads around just based on, where we are right now. So I'll pull up a chart as we usually do, and we'll have a look.
I'm very, very keen to look at it through this lens as well, because as you're pulling that chart up, part of the challenge here when we have had this big move is that I think people just look at the move relative to where it's been and go, well, this is all I know is what's happening in front of me at the moment. It moves so quickly, it's probably overbought. I think that's where it is important to zoom out, like you've said, sort of look at the bigger picture. But we really do need some better metrics around this, because a lot of those indicators that people will be using to track momentum or any of that really get broken down a little bit when you have a breakout move such as this. It's out of the range of what it has been doing typically.
So true. And, if you look at it over the short term, a lot of those will get reset. But in the long term, if you're looking at it over a 12-month chart or something like that, they can stay elevated for a while. And, there's an expression that goes, people often overestimate what can happen in a year and underestimate what can happen in 5 years. And I think that's very true for markets as well, because you get people talking about, gold's going to do this in 6 months or 12 months, and same for silver. And quite often those targets don't get met in the short to medium term. But then when you think about what gold is going to do in 5 or 10 years, people are shocked. They're like, oh, no way it's going to do that. And those usually, not only get met, but they tend to get exceeded. So let's have a look at this government debt chart. Now, I'll just zoom in on this a little bit. So what we've got here is the US government debt divided by the gold price. And you can see it going back to 1945, it's really been trending. It's an oscillator, but in an upward channel. So there are times when the government debt is, when gold is undervalued in comparison to the US government debt. And there are times when it's, let's say, overvalued or appropriately valued based on this channel. Now, this is, it's a channel that's been on for 80 years. It can absolutely break out in either side of that channel, but 80 years of data is quite solid. And looking at a ratio of about 6, that would bring it to about US, $5,000 an ounce. And that
Right.
would be where we were in 1945 as well. So that's a fairly, sort of short to medium term target. Makes a lot of sense that we'll have that down at this level. That this will hit the bottom side of this upward channel.
So I just want to ask you a question about that. So that's a very interesting metric to look at, because that's saying if you ignored inflation in other terms, that you're getting back to, what did you say, the 40s, with a
Yes,
valuation still even higher than where it is now. That's quite a powerful statement about gold, isn't it? Really, if you think about it.
exactly. So if anyone's looking at gold in dollar terms and you compare it to the price in 1940, they might think it's gone up heaps. But if you compare it to the US government debt, it's actually at that same level. So it's very
Yeah, wow.
appropriately valued to where we were back then. And notice that that is actually the bottom end of this channel. So when we go to the top end of this channel, that's obviously a much more extreme valuation as well. So at the moment, gold is, sort of close to being undervalued, if anything, when you look at it in US government debt terms. Now, if you price gold in any other metric, like you can look at it priced against the NASDAQ, which is a very compelling chart as well, which I'll open up in a second, where you can see it breaking out of a long-term macro downtrend, just breaking out of that downward sloping resistance line. You can price it in the S&P, where you can see it's undervalued. So, priced in relation to most major stock markets, gold undervalued. Priced in relation to US government debt, it's close to being undervalued as well. So yeah, we've had a strong move, but like I said, we haven't seen anything yet. And when you project this chart out to about 10 to 15 years from now, you get a figure of about 25,000 US. So $25,000 US, that's like $33,000 Australian per ounce. That's a 5x multiple from, roughly from where we are today in the next 10 to 15 years. So that's where we are with gold. Really what I wanted to focus on a little bit today is silver, because, we haven't done one of these episodes for a while. And I thought it'd be good to have a quick look at where we are with silver as well. The reason I bring up gold is because I think it provides a nice basis for valuing silver just using the gold to silver ratio, right? So we've got a long-term price target based on US government debt for fair value of $25,000 an ounce gold in US dollar terms. If we look at the gold to silver ratio, the long-term average, as you can see here, over 100 years is about 56.2, 56.62. And we can see here that over 100 years, it's essentially an oscillator, right? So it spends multiple decades in this higher region. This was leading into World War II. This is sort of where we had World War II. And then we had multiple decades where the gold to silver ratio was between that 20 to 40. And now we've had multiple decades where it's sitting up in the higher regions again, and it's starting to curl over now. Essentially, after every major crash, you have the gold to silver ratio fall off. Actually, I can pull up another chart that's a little bit got a little bit more detail on there for the gold to silver ratio. Probably my favorite chart of all time, which I share literally every chance that I get. But this one here, you can see the gold to silver ratio is in light blue, and the silver USD price is in dark blue. So every major recession that we've seen, the gold to silver ratio falls off straight after that recession. But it was after the Great Depression that you saw the gold to silver ratio fall off at a centennial scale. Now, this was that same GSR chart that we were looking at before, decades in the high region, decades in the low region, and now decades in the high region as well. If you take a long-term average, even, around 50 for the gold to silver ratio, that $2,500 target for gold in US dollars gives you $500 an ounce for silver. That's like $750 an ounce Australian for silver in 10 to 15 years. And that's at a gold to silver ratio of 50. There is a strong argument to be made, and I don't want to get too ahead of myself. So, let's just leave it at 750 to be conservative. But there is a strong argument to be made that the gold to silver ratio in 10 to 15 years from now will actually be in one of these phases here, where it's spending multiple decades well below 50. Because we're currently in a fourth turning, getting into the first turning, and the last one obviously ended with this World War II, and the gold silver ratio fell off a cliff and spent decades down there. So if we're looking at the first turning, we're looking at the GSR doing this. And then as we get into the second turning, that's like 40 years from now. So that's way, way down the track. You've got the GSR spending multiple decades in there if history were to repeat. But certainly a GSR sub 50 by the time gold's at 25,000 an ounce is reasonable to expect. So even if, at 50, you've got it at $750 an ounce Australian. So when people are getting really concerned with, silver's gone up to like $90 an ounce, for a coin and things like that, have I missed the boat? Well, when it's sitting at, could you imagine paying $800 for a 1 ounce silver kangaroo? At that stage, it's going to be a whole different world.
But
So
people probably couldn't imagine, to put that in perspective, it wasn't that long ago I remember buying 1 ounce silver kangaroos for $20 in the
yes,
ballpark of that.
exactly.
And I couldn't really imagine today selling them for $90, right? Like
Exactly.
that is the same imagination process, isn't it? Like it's a similar multiple.
Exactly right. And keep in mind, like, we're talking 15 years down the track, a loaf of bread is going to be like $150. So, it's going to be a very different world. And, we might be using a currency might look very different. We might have some sort of CBDC and, more than likely some sort of universal basic income. And the world's going to probably look quite different in 15 years with everything that's happening with AI. But it just shows the power of simple long-term investments that you don't need to get too cute about, where you just stack and hold and don't get caught up in the short-term price movements. Oh, it's gone up to 80 or it's down to 60. Doesn't matter. You're sort of stacking for that 10 to 15-year time frame.
And I wonder, you make a really good point. Even if people go, well, I don't believe Drew's target, right? Like let's say you throw Drew's target, you throw the $700+ out the window. Something that you've said to me previously that really just I was reminded of when you showed that chart of the long-term GSR is 50 to be the average over 100 years means that it has spent an equal amount of time or distance at least above and below that. That's how you get an average, right? You don't get
Right.
that average if it didn't spend time on both sides. If it was always up where it is now, then the average will be higher. If it was always lower, the average will be lower. That's just how averages work. And it's such a powerful point because people can't think in 100-year timeframes. So you can only remember what you know. And we think of a gold silver ratio above 50 because it's spent a lot of time there. When we saw those brief dips below, they were very brief and it was almost like, oh, we missed that opportunity because then it's back up to what it always is. But what it always is relative to your memory, and your memory is as short as not 100 years.
So true. And that shows the power of recency bias, right? Like just how powerful that is because, the gold to silver ratio has been in that higher region between, roughly 70 to 90 for like 30 years now, 25 years roughly. So you've got an entire generation of people that will find it very difficult to wrap their heads around that number looking like a 20 or a 30. But leading into 1980, you had an entire generation of people that couldn't imagine it above 50 because you just had, all these people, especially leading into that silver boom, where we're like, well, this is just the appropriate value of it. And there is an argument to be made that the appropriate value, like, that 50 averages the last 100 years. But if you look at thousands of years, that average is closer to 16. So, in the last 100 years, we've lived in this US dominated global financial system. We had the gold standard and then we got off it. But if you look at, every great civilization that's ever existed prior, more often than not, the gold to silver ratio is like way, way below where we are right now. So saying that it falls sub 50 is, even in the current financial system, very reasonable to expect. It's where we are right now is unreasonable, if anything. So that recency bias is a very powerful thing. I just wouldn't let it call too many of the shots.
I can't imagine. I'm looking forward to the day when I can swap my tube of 25 roos for an ounce of gold like that.
Yeah.
That is the sort of thing that we can't process properly now. But as you point out, we might have a very long time where that's just the norm.
Exactly. And, just to add a bit of, because we've got, the projections from the US government debt, I'll pull up a chart of just a very simple technical projection of the silver price. And this is, probably the biggest cup and handle pattern that I've ever seen on any financial market. So what we got here is the 1980s peak here. This is a logarithmic chart. Now, a lot of people, there's a lot of questions around, do you use a linear scale or a log scale? Generally, when you're looking at a very long time frame and you're looking at a very volatile asset, log charts make more sense. And, if we're looking at something over 50 years, and you're looking at something with hundreds, if not like 1,000% price movements over the chart, I just think a log chart makes a lot more sense. Now, you can do a combination of log and linear as well, and you will get different price projections for each. But looking at this one here, it's interesting that you've got this very basic pattern, cup, handle, with this massive rally recently that everyone's getting really excited about. All we did was hit this resistance level that goes back to 1980. And that handle has now formed, and you obviously, you're always going to get a little bit of resistance there. I shouldn't say always. You could obviously just shoot straight above it and then back test it. But this is a sensible point to have a little bit of resistance. Once this cup and handle breaks out, and the pattern starts playing out, you've got your first target at about $500 silver. And that confluence of gold being projected with the US government debt at 25,000 and the gold to silver ratio long-term average of 50 brings you a $500 per ounce US silver is just backed up by this very simple technical pattern here. And it's important to note as well, just, I'll quickly just zoom in on this a little bit so people can see the numbers a little bit better. But we've got $548 US as your first target, right? And just really quickly to go back to this chart here, you can see with the GSR, when it's spending multiple decades in that higher region, silver basically spends multiple decades chopping around sideways, consolidating, forming a huge bullish pattern. Then when the GSR falls off, silver gets a really strong bid. And then when it spends that multiple decades down there, silver gets a huge blow-off rally. We've got that confluence here as well. We've got that multiple decades up here. Silver's sort of been chopping around 50 years in this, forming this massive cup and handle pattern. And that's where recency bias is so powerful as well. People are just like, when I talk to people about gold, everyone's really excited. Like I'm talking about people out in the real world, people that don't really invest much, that generally, don't know much about markets. Will say, oh yeah, gold's done really well because the news is reporting on it. But when you talk about silver and gold to silver ratio, like, oh wow, okay, silver, that's an interesting one. So obviously silver investors are ahead of the curve right now. But it's in this phase here where everyone's going to be talking about silver. And the gold to silver ratio then spends decades here. So we've got that decades of consolidation and the decades of the high GSR. And what we're looking forward to now is the decades of that bull pattern playing out, whether you're looking at it based on the gold value in 15 years, the average GSR, or that simple technical pattern, it would make sense that the GSR then falls off here as well.
Can you pull up again the cup and handle pattern? Because I'd just like to point out something really interesting when we've discussed this sort of off camera previously, not today, but previously, looking at like the point that I was making around the cup and handle. I was actually looking at the handle of the cup and handle as a cup and handle.
Yeah.
And the point, the question, I suppose, or the point that I wanted to sort of bring up with you here is, over that time frame, it's a pretty compelling pattern itself, just within the handle of that, because it's formed a beautiful cup and handle pattern itself. When you zoom out, you sort of said, yeah, that's fine, because I was really looking at that and projecting off that, saying, oh, well, it's still got more to go, but I'd expect a dip first. And you were saying, yeah, but zoom out and look at the longer term. That is generally even more powerful, isn't it? If you've got not only two cup and handles inside, like a nested set of cups we have here. It's like we're cooking or something. But it's not only that; it's the fact that the longer the pattern has taken to form, doesn't that generally relate to the power of that pattern in resolving? That it becomes almost more certain and certainly more powerful if it is a very long term forming pattern. Is that how you see this?
Yeah, 100%. And that's a really important point, that any technical pattern, it's not 100% guarantee, right? So I'm sure most people already know this, but when you see a technical pattern, they generally tend to have probabilities of playing out, and some patterns are stronger than others. So TA is just a, it's just a statistical, advantage. But that probability goes up on longer term time frames. So if you're looking at something on a 5-minute chart versus a 4-hour chart, a daily or a weekly chart, a pattern on a weekly has a lot more credence than a pattern on like a hourly chart. And this is a pattern on the monthly chart looking over 50 years. So it's about as powerful as you can get with this specific pattern. And it's never something I would use in isolation. It's really just looking at the overall macro environment, and it adds a little bit of confluence, to your overall projection. But yeah, it's a very high probability setup if you're looking at it over 50 years. That's for sure.
Amazing. Look, it's great to have you back on here. I know people will be very keen, have been very keen to hear your update on what you're thinking at the moment. But when you're looking at those 50-year cup and handle patterns, I suppose we can go for a little bit of time without out you here to update us, because they do take a little while to unfold. I suppose that's probably fair. But look, appreciate your deep dive on that and getting us back up to date. It's always great to have these conversations, and it's getting me quite bullish again, particularly now that I'm seeing that price push back up after that little bit of a pullback that we've had. It's an exciting time. So yeah, thanks for your work on it.
Absolutely, Chris. No, it was a pleasure to chat. And, I think there are definitely some opportunities coming up in sort of this year and over the next 6 months to examine the portfolio. And, if there's any room to add, just during these consolidation periods are always a good time to take stock and see, when, if and when you want to sort of add to your position. It's usually during these consolidation periods. So, yeah, it's a good time for us to keep these videos going and keep people informed. Good to chat to you as well.
Oh, wonderful. Look, I'll take that as we'll get you back on again soon. I know people will be keen for that. Look, thanks again. Thank you, everyone, for watching. We'll chat again soon.